Everybody, my name is Bennet Tchaikovsky, accounting professor here. Welcome. This is my presentation of intermediate accounting. There was a viewer who asked for this. I think it's the right one, but we're talking today about error correction. If you have the 17th edition, this is problem 2210. If you have the 18th edition, this is problem 2110. The only difference between the question is in the year of the book. So that's what they like to go through and do. I totally get it. So the textbook authors are Don Kieso, Jerry Weygandt, and Terry Warfield. The question used in the presentation is copyright 2019 to 2022 by John Wiley and Sons, or Wiley. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennet, actually now be 2024 by Bennet Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennet Tchaikovsky and not the authors of the textbook or Wiley. So I actually made a video earlier today, this is August 2024, about the importance of doing problem-based questions when you're preparing yourself for the CPA exam or task-based simulation. So let's get to it. Okay, and I apologize. I'm assuming you have this book at home. I don't know how else you would be looking at these different questions, but that's what I'm kind of going through and assuming. So we have a situation here where basically you have error analysis and correction. You've been asked by Roberts, a small manufacturer of precision tools and machines. Your client is interested in buying the business, and arrangements have been made for you to review the accounting records. Your examination reveals the following information. So we have all of these different things, and we know that for the year ended March 31st, 2024, year ended March 31st, 2025, and then the year ended March 31st, 2026, the net income before taxes. Okay. So this was 71,600, 111,400, and then 103,580. So what we're effectively going to go through and do is basically take these amounts and go through and adjust them according to the additional information. And so we've got over here a relatively small number of machines have been shipped on consignment. Sales price was determined by adding 25% to cost. Assume the consignment. Okay, so we've got all this information here. We've got sales per books and warranty costs, bad debt. We've got over here the banks deducts different parts, sales commissions, and then a review that the corporate minutes reveal a manager is entitled to a 1% bonus of income before deducting taxes and the bonus. So right over here, present a schedule showing the revised income before income taxes for each of the years ended March 31st, 2024, 2025, and 2026. And then over here, prepare the journal entries you would give to the bookkeeper to correct the books. Assume the books have not yet been closed yet for the fiscal year ended March 31st, 2026. Disregard correction of income taxes. Okay. So the first thing we need to go through and do is look here. So this is, we're going to start over here with our schedule, or the income before income taxes. And then what we're going to do is we're going to look at each of these different items and figure out what needs to be adjusted. So let's read through these. Okay, a relatively small number of machines have been shipped on consignment. These transactions have been recorded as ordinary sales and billed as such on March 31st of each year. Machines that billed in the hands of consignees amounted to 2024, 6,500, 2025, there were none. And then 2026 is 5,590. Okay. So on March 31st of each year, machines billed and in the hands of consignees. And then it basically says I assume the consignment machines are sold the following year. Okay, so what we've got a problem is that these amounts should, if they were sold the following year, they should not have been basically listed out over here as sales. Now, in terms of, this is really talking over here is about the sales price. Basically over here, the transaction has been recorded as ordinary sales, and right over here. So if the sales price was determined by adding 25% to cost, so in 2024, if 1.25x, if we say that x is the cost and we're adding 25% equals 6,500, then the cost of these machines should be 6,500 divided by 1.25x, or by 1.25. And so over here, this is going to be 6,500 divided by 1.25. Okay, or a total over here of 5,200. So this was the cost. So the profit that is going through and being included is going to be 1,300. Okay, so basically what we have over here is that when we're looking at this, like the profit that's going through and being included, it shouldn't be included in this year. Rather, we should be booking the profit in the following year. Okay, so right over here, so we're going to have consignment sales. And again, the concept of consignment sales is that we're basically holding the goods, we're basically getting a percentage upon when they're actually sold. So the profit for us is really coming down to that markup. So basically, if this was not sold until the following year, then we basically need to remove 1,300 related to the consignment sales for 2024. But then there were no consignment sales the following year, but assuming that the 6,500 was sold the following year per the hypothetical, we would be adding in over here 1,300. Now, the problem with this one right here is going to be 5,590. So we need to figure out what would our commission have been, or what would have our percentage have been on the consignment. So over here, you're going to have 1.25x equals 5,590. X is equal to 5,590 divided by 1.25. So you're going to get a total of 4,472. So that basically means on the profit on this, so the cost was 4,472. So our profit on this one that we should not have been reporting is 1,118. So again, we're focused here on removing the profit because, like right over here, it does not belong to it. Basically, we don't really hold that inventory. Okay, so right. So coming over here, number 3. Okay, so on March 25th, there were 2 machines shipped to a customer on a COD basis. That basically means cash and delivery. The sale was not entered into April 5th, 2025, when the cash was received for 6,100. Okay, so basically, so this is taking place over here in 2020, in the fiscal year ended 2026. Remember, this is going from 4/1/25 to 3/31/26. This is 4/1/24 to 3/31/25. And this is going to be 4/1/23 to 3/31/24. So over here, basically the machines were not included in the inventory as of March 31st, 2025, because title passed on March 30th. So basically we should have included the sale here, and therefore we need to go through and remove the sale over here. So that's how we're going to go through and handle the issue with basically machines, basically cash on delivery. So those are our two adjustments right now. This is going to be for number 2 and number 3. Okay. Now for this next part over here, all machines are subject to a 5-year warranty. It is estimated that the expense ultimately to be incurred with the warranty will amount to 0.5% of 1% of sales. That actually language confused me when I first saw it. It basically means it's 0.005. The company has charged an expense account for the warranty costs incurred. That is absolutely incorrect. So when we go through and we're basically looking at the sales. Okay, so when we're going through and looking at sales, we have sales over here for 331.24. So it tells us over here that the sales are in fact 940,000, 1,010,000, and then 1,795,000. Okay. So when we have this over here, basically the first thing we need to kind of go through and do is we need to make some corrections here, right? So the first one in terms of going through before we start multiplying percentages is we need to figure out, well, what is our true sales number? And we've already had two basically, mistakes basically like listed out above. So the first thing we need to go through and basically make an adjustment for is basically going to be the assignment, basically the consignment sales. Okay, so essentially, if the gross amount, now what I did up here was I just basically got out the net amount or actually the profit on this. But when it comes over here, I'm assuming that I'm including this gross amount in the consignments. So I'm going to go ahead and basically back out 6,500 or the full amount of the consignment sale. That's going to basically go back in over here the following year when it was actually sold. And then there were no consignment sales in 2025. And then I need to make the deduction for the gross amount of the consignment sales in the following year. I also need to make the deduction or the correction for the cash on delivery machines. So over here, I'm going to be adding in 6,100, and then I'm going to be subtracting out 6,100 to remove that sale. The distinction between the consignment sales of 6,500 and going through and reporting the profit, really, I think the way I would look at it is, well, we're really adjusting net income, right? That's what we're kind of going through and adjusting. This part over here, the cost of sales was correctly reported in that period, basically was correctly reported in this period. So we're making the adjustment to revenue. But on this, we're basically going through and making a gross adjustment. So over here, our sales as corrected for 331.24 is going to be 933,500, 1,222,600. And then over here, this is going to be 1,783,310. Now, in terms of the warranty, how much should we have recognized in warranty expense? Right. Well, this is going to be 0.005 or 0.5%. So warranty percentage. And remember, when you're going through and recording warranties, right, there's going to be warranty expense to best match basically the sale. So if I'm giving a 5-year warranty, the best thing for me to do is to match the expense in the year the sale occurred. So I would be debiting warranty expense, crediting warranty Liability, if it's going to be in the future, I may make part of it non-current. So I've got over here sales as corrected, warranty percentage, and then the warranty expense. So my warranty expense should have been 4,667, or over here, we're just going to round it to 4,668. This is going to be 5,113. And over here, we should have recognized a total of 8,916.55. We're just going to call this 8917. So that's basically our warranty expense. All right, now here's what we should have booked. But the question is how much warranty expense were we going through and recording every single one of the years? So my expense recorded over here for 2024 was a total of 760. My expense recorded in 2025 was 1,670. And over here, the warranty expense I recorded in 2026 was a total of 3,850. So this is what I should have done. This is the amount of expense that I did record collectively. So my warranty expense, or my adjustment for warranty expense, or my adjustment to warranty expense, this is going to be 3,908, 3,433, and then lastly 5,067. So what I'm going to go ahead and do is I'm going to go ahead and move this over here. And we're going to put over here, we're going to have for warranty expense adjustment. Okay, so I'm going to take off. I didn't record enough. So I'm going to reduce my income before taxes by 3,908, by 3,433 for 2025, and then another 5,067 for 2026. Okay, let's go ahead and look at the next one. Bad debts have been recorded on a direct write-off basis. This is a huge no-no. Experience of similar enterprises indicates that losses will approximate 1% of receivables. Bad debts written off were. Okay, so essentially, when I go through and look at this, the adjustment, right? So in 2024, right? So my bad debt expense should have been 2,334. This should have been 2,557, and this should have been 4,458. That's how much I should have recorded. But the reality is in 2024, what I went through and did, so the expense recorded, this would have been 750. This was 2,000, sorry, this is 1,320, and this is going to be 3,850. So my bad debt expense adjustment is going to be over here at 1,584, 1,237, and then 608. So what we're going to do over here, similar to the one we just did. Okay, so I need to record another 1,584, 1,237, and then 608. So that was relatively straightforward. I don't know how they could have made it more difficult, but who knows? Okay, so now the bank deducts 6% on all contracts financed. Of this amount, 0.5% is placed in a reserve to the credit of Robert's company that is refunded as finance contracts are paid in full. So this is what we call, if you remember, an accounts receivable factoring, or you basically have, basically we're going to get cash, we're going to basically write off the receivable, and then we're going to have like a due from factor, right? For the basically, and this is essentially a holdback that the bank or the factor will use to basically make sure that they're going through and collecting everything. So right over here, thus Robert should have a receivable, right, the due from factor for these payments, and should record revenue when the net balance is remitted each year. The reserve established by the bank has not been reflected in the books of Roberts, right? So we're not reporting enough income. The excess of credits over debits, the net increase to the reserve account on the books for each fiscal year was as follows. Okay, so over here, so we have contracts financed. This is going to basically be over here. This is going to be 3,000. This is going to be 3,900, and this is going to be 5,100. So that's what's going on with number 6. Let's take a look at number 7. Commissions on sales have been entered when paid. Commissions payable on March 31st of each year were as follows. Okay, so here's a problem. You record commissions as they are earned by your salespeople. You don't do things on a cash basis, right? So over here, so commissions, right? So think about it like this. The expense over here was basically commissions on sales have been entered when paid. So over here in 2024, I should have recorded 1,400 in commissions, but this was an amount that was payable, but I never recorded it. So this is going to decrease my income by 1,400. Now, for the following year, this is where it gets a little bit more interesting. So now, because I basically recorded the 1,400 in the following period, but now that I'm recording this here, it's going to show an increase from 2024. But this 900 that was payable on 3/31/25 that wasn't paid to the following year, this is why I'm going to have an adjustment of 500. So this is going to increase my net income by 500 because this was actually paid in 2020, or actually this was recorded as an expense in 2025, which it should not have been. Now over here, 2025, I'm going to have the same thing, but in 2026, the amount was 1,120. So over here, my deduction is going to be minus 220. Again, when you kind of think about it, well, this amount was basically payable, right? So therefore, we should have recorded the expense, right? The 1120, but this is being contradicted, or this is being downgraded because there was 900 that was recorded as an expense because it wasn't paid until 2026. So fun stuff. Okay. Now that we have all of these done, now the last one, it basically tells us, as a review of the corporate minutes reveals the manager is entitled to a 1% of bonus of the income before deducting income taxes and the bonus has never been recorded or paid. So my adjusted net income is going to be 66,408, 118,520, and then 95,567. That's adding up all of our adjustments. Less the bonus. So the bonus over here is going to be at 1%. And so then the net income post adjustment This is going to be 66,408 minus our commission, our bonus, or 94,611. Okay, so when it comes down over here, so this is basically the first part of the question. I'm going to go ahead and stop the video here, and I will probably go through and make a part 2 for the journal entries. So I want to thank you for being with me here today. Please like and subscribe to the channel. If you have comments or questions, it's always good to get more feedback. And I'll try to make these videos for you. Have a great day.